So we are doing double taxation relief. Okay. So this is the concept that a person can be taxed at two places where you are getting your source of income and the country in which you have a residence. Okay. You are the resident status that you are a resident of the country. You can be taxed in two countries. Okay. It comes from the source rules of taxation as well as the resident rule of taxation. So that's why there is a need felt for double taxation avoidance agreements between two countries, if to avoid such kind of a situation. Otherwise, you will be paying taxes in both the countries, and then it will become difficult for the organizations to become competitive in this. In the competitive world today. So fine. So there are two kinds of reliefs which are available. So let's come to the the place where we can understand things and how the relief is given. So there are bilateral and unilateral kind of relief. So that means there is a bilateral and unilateral, where that means if two countries have entered into a bilateral agreement, or if the two countries don't have any agreement to avoid tax. Okay, bilateral method. Read this, Kajal. So basically, these are called bilateral method where the two countries, enter into an agreement to avoid double taxation. Okay. So read this. So if this is there, then the one country exempts the income, the other country will be levying tax on the same income. So it will be taxed only at one place. Okay. So that means, the second method where, which is a bilateral method where you pay tax in, in the country, okay, and this is called tax credit method. So that means if I am earning some income in England, okay, I am a resident of India, so I am paying tax in England as well as I have to pay tax in India. So whatever tax I have paid in England, I will get the credit of the same tax in my return here. So this is a simple method. You pay tax in England, no problems, okay, but you can get a credit in India for that tax. Okay, so that is the method. Okay, unilateral method. So DTA is basically double taxation avoidance agreement. So in case if we don't have an DTA agreement, so still there can be a unilateral relief given under Section 91. Okay, so we'll understand this mechanism. Okay, for through our examples. Okay, so I will just go through straight away to example to understand that. Okay, just read this question. So that means here, there's a assessee called Yogita Kumari. She's a dancer, and she has, performed a dance outside India, and she has earned an income of 75,000. And she has to pay 10,000 rupees tax in that country. Okay, but she's a resident of India. Okay, so India doesn't have any double taxation avoidance agreement with that country. So her income in India is 5 lakhs. So we have to compute the tax liability of Yogita for the assessment year 2020-24, assuming that she has deposited some money in PPF, and she has also deposited some 20,000 as medical insurance premium for her father, who is 65 years. Assume assessee was exercised the option shifting out of the default tax regime. Okay, so that means he has shifted out of the the default tax regime, and she's going to pay tax under the normal regime. Okay, fine. So this is what we have to do. So what we'll do, I'll just open the Excel sheet here in the morning, which I opened. So just open that, and the question number 2, we can just go there. So this is the same question. Okay, Yogita Kumari. Fine. So the answer. So here what we have done is, her income is how much? 5 lakh from in India. Is that clear? Foreign income is how much? 75,000. So total income is 5 lakh 75,000. So if you see the question, she is earning 75,000 as income from outside, where 10,000 has been deducted, and she has earned 5 lakh rupees in income in India. Okay. So we just go back. So this is his total income, Indian income and foreign income. So GTI is 5 lakh. Now she will get some benefit under, because she has, deposited some money under PPF. So 10,000 rupees. Okay. The limit here is 1,50,000 under ELS schemes, under Provident ATC. So this is ATC benefit. Okay. So she's going to get 10,000 because she is under a normal tax regime. She will be allowed these deductions. If he would have opted for the 115, that is the default tax regime, then this deduction was not allowed. So medical insurance premium for his father, who's a senior citizen, 20,000. So her total income will be 5 lakh 45,000. So if we just calculate this, so this will be basically the total income, and the total income here, gross total income is how much? 5 lakh 75,000 addition of 2. Okay. So then she is allowed 10,000 rupees reduction for PPF and medical. So this is 80D. Fine. Okay. So these 2 deductions are allowed to her. So total income will be 5 lakh 45,000. Is this clear to everyone? So Raksha, Kishore, Manu, Diya. Okay. Now on 5 lakh 45,000, under the normal tax regime, 0 to 2 lakh 50,000, tax is 0. Okay. So there is no tax. From 2 lakh to 2 lakh 50,000 to 5 lakh, it's 5%. So it will come to 12,500. Okay. Fine. And then between 5 lakh to 10 lakhs, so which is 5 lakh 45,000 here, this income. Okay. So this income I have taken from here. This is coming from here. So that means from 5 lakh to 10 lakh, 20% on 45,000. So tax will be 9,000. Fine. So total tax will be then 21,500. Is that okay? Fine. Then there is a 4% cess, okay, which will be 21,000 multiplied by 4%. Okay. So total tax will be 22,360. So she has to pay 22,360 rupees tax in India. But she has already paid some tax abroad also. So how we are going to work out that? So first, we are going to calculate average tax rate in India. So she has paid a tax of 22,360. Okay, fine. On total income of 5 lakh 45,000. So that means in India, she has paid a tax at the rate of 4.1%. Is that okay? So this is the average tax rate of India. Whereas the average tax in the foreign country is 10,000 divided by which is basically the tax deducted and the income abroad. Okay, fine. Fine. So the tax rate in the foreign country is 13%, and in India, what she has paid tax is 4%. Okay, so that means she will be allowed on 75%, which is doubly taxed income. So which is 75,000. She will be allowed a tax benefit of 4.10. So this will be the relief under section 91. Okay. So she has to pay only 19,000 tax in India. Okay. Though of course she has suffered a tax of 10,000 abroad, but because the tax in India was just 4% and abroad it was 13%, so she will be entitled for only 3,000 reduction. So balance she has to be paying tax. I mean that 7,000 will be from her pocket. So the total tax liability will be much higher. So she will be entitled only for a 4%. Okay. So now we can just take another question before I mean, you can answer any other question. You can raise any question. So let's see this where things will get clear. Okay. First of all, read this, Suraksha. So this is a relief under section 91. Okay. Yeah. So in this question, there was no taxation relief. So it was unilateral under section 91. So read this. So that means this is the case which is relevant to this example where she was Indian resident. Of course, it is not mentioned. Yogita Kumari, a resident individual. So she is resident of India. Okay, she has paid a tax abroad. Okay, and India does not have any double taxation avoidance agreement to the country. So written in the question. Okay, fine. And her income in India is 5 lakhs. And we have to calculate the tax liability of Yogita for the assessment year. Okay, and assuming that she has opted out of 115B. So there's one more question, and then you can ask questions. Okay, okay. Just read this. Okay, read this. Okay. This 25,000 rupees. Okay. Okay, so that means she is going for the normal, tax regime, which was a regime in the earlier era. So she is not opted for that. So let's say of the answer two. Okay. So Indian income, sorry, question number three. So this was the question number three and answer. Okay. What is the Indian income? 19 lakh 20,000. Okay. Which is there in the question that she has earned income in from playing basketball match in India 19 lakh 20,000 and income from playing basketball match in Netherlands 12 lakhs. Okay. So foreign income is how much? 12 lakhs. So total income 31 lakh 20,000. Okay, which is the addition of these two. Then life insurance premium, which is ATC benefit, since she has opted for normal tax regime. Okay. Then 80D reduction, which is medical insurance paid for father. Okay. So total income will be 29 lakh 75,000. Is that clear? Then on 29 lakh 75,000, the tax has been calculated here, which is up to 2 lakh 50,000 no tax, from 2 lakh 5,000 to 5 lakhs, 5%, 12,500 is the tax. Then from 5 lakh to 10 lakh, the tax rate is 20%. So that means, on 10 lakh, on 5 lakh, there will be a tax of 20%. This is 1 lakh. Then 10 lakhs and above, which is, 19 lakhs 75,000. Okay. Which is basically the difference between this thing. Okay. So our income is how much? 29 lakhs 75,000. So up to 10 lakhs we have calculated. So for 19 lakh 75,000, the tax will be 5 lakh 92,000, which will be 30% of 19 lakh this thing. So which means the total tax will be 7 lakh 5,000. Okay. And the cess will be 4%, which will be 7 lakh 33,000. So tax will be 7 lakh 33,000. Is that clear? So this is the tax which is paying on her income. Now, what is the average rate of tax in India? Because she is paying what, 7 lakh 33,000 on an income of 19 lakhs 29 lakh 75,000. So the rate will be 24.5%, which is 7 lakh 33,200 divided by 29 lakh 75,000. So that means the average rate of tax in India is, for her income, is 24.9. Now she has paid tax at the rate of 15%. That means 1 lakh 80,000 divided by 12 lakhs. Okay. So we can just use this. So she has paid 1 lakh 80,000 tax abroad on an income of 12 lakhs. Okay. So which means the tax rate, average rate of tax in which she got the income was 15%. Okay. So which means that she will be getting a relief of 1 lakh 80,000, the entire amount. Okay. Fine. So which will be basically, we can just see how it has been calculated, which is 15% of 12 lakhs, because the tax deduction will be 15%. Okay. In this case, because it has to be, the tax rate in India is 24%, but the rate of tax in abroad is just 15%. So she will get not 24, but 15%. Okay. Which will be the entire amount of 1 lakh 80,000, which she suffered abroad. So that means she has to pay tax of now 5 lakh 33,000, which is, the tax of 733 minus 1 lakh 83,000. So this will be tax payable in India. So she'll get a full relief of tax payable. Whatever tax she has paid abroad, because it happens to be, a lower percentage of tax which is in India. So she will be entitled for 100% reduction of tax liability. Is this clear?